So, are you looking for ways to grow your portfolio that go beyond the usual stocks and bonds? Well, you're in the right place. Today, we're diving into the pretty amazing world of fractional investing, where owning a piece of a Picasso isn't just a multi-million-dollar fantasy anymore.
I mean, let's be real. Watching the stock market do its daily roller coaster thing can be, well, it can be a lot. It's a feeling a lot of us have, and it's pushing a ton of investors to look for other ways to bring some stability to their portfolios.
And if you're feeling that way, you are definitely not alone. Get this. A recent study found that nearly half, 45%, of investors are actively looking to diversify into what are called alternative assets. That's a huge shift, and it shows there's a real hunger for investments that aren't tied to the whims of the traditional market.
Okay, so let's dig into what this new kind of portfolio for, say, 2025 might actually look like. We're going to look at why that classic mix of just stocks and bonds might not cut it anymore, and why so many people are on the hunt for assets that kind of dance to their own beat.
So, what are we even talking about with these alternative investments? Well, we're talking about non-traded assets. Think of them as real, tangible things you can, in theory, touch, like a masterpiece painting, a case of super rare wine, or a one-of-a-kind collectible. The big difference? You won't find them on the New York Stock Exchange.
And wow, this slide really puts the change into perspective. In the old days, investing in fine art was a pretty exclusive club. You needed, $100 grand at least, plus invites to these elite auctions. Fractional investing completely smashes that barrier. Now, you can get started with as little as $500 on a website. And you even get access to secondary markets to sell your shares, which used to be a massive headache.
Right, so why? Why would you want a tiny slice of a Picasso in your portfolio anyway? Let's get into the real appeal here. What makes these alternative assets so darn attractive, especially in the economy we're in right now?
Well, for starters, the potential returns are pretty compelling. I mean, just look at this. Historically, fine art has pulled in average annual returns somewhere between 6 and 11%. Rare wine offers that nice, steady growth. And then you have collectibles, which can jump up to 10 or even 15%. This isn't just about owning a cool thing. There's some serious financial potential here.
Let's zoom in on art for a second. Over the last 2 decades, blue chip art, we're talking the big names like Warhol or Basquiat, has averaged an 8.9% annual return. And here's the really crucial part. Its performance doesn't usually follow the stock market, which makes it a powerful potential hedge when inflation is going crazy.
So let's just quickly recap the big whys. First, you're getting serious diversification because these assets don't live and die by the S&P 500. Second, you get that potential hedge against inflation. And third, you're finally getting access to this whole class of high-value assets that until recently was pretty much off limits to everyday investors. Okay, so you get the why. Now let's talk about the how. This might seem complicated, but I promise it's become shockingly simple. Let's just walk through the actual practical steps to make your very first fractional investment. And the best part is, you don't have to go on some wild goose chase to find these things. There are now really well-established, reputable platforms for pretty much every category. Masterworks is a huge name in fine art. Vinovest is the go-to for wine. And then you have platforms like Rally that focus on collectibles. Think classic cars, rare comics, you name it.
So let's use Masterworks as a quick example of how it all works. It's really straightforward. You sign up for a free account, you fund it, the minimum is about $500, and then the fun part starts. You get to browse their curated collection of famous artworks, research the artists right there, and when you find one you love, you just buy shares in it. The platform handles all the boring stuff like insurance and storage, and you can track how your investment is doing and eventually sell it on their secondary market. Easy.
Okay, time for a reality check. We absolutely have to talk about the other side of this coin, because as exciting as all this is not a get-rich-quick scheme. There are some very real risks you need to wrap your head around before you even think about jumping in. So what should you watch out for? First, something called illiquidity. Unlike stocks, you can't just press a button and sell your shares instantly. It might take some time to find a buyer. Second, just like anything else, values can go down, not just up. There are absolutely no guarantees. Also, be really mindful of the fees. Platforms charge for management and sales. And finally, authentication is everything. You have to trust the platform has done its homework, which is why sticking with the big, reputable names is so important.
Okay, let's look at some numbers to see how this could play out. Here's a simulation. You invest $5,000 in an asset with a nice, stable 10% average annual return. You can see that steady, compounding growth over 5 years. It's not going to make you a millionaire overnight, but it's consistent.
Now, let's contrast that with something a little more volatile, but with a higher potential return. Say a hot collectible averaging 15% a year. As you can see, after 5 years, your $5,000 is worth over $9,000. But that higher reward comes with higher risk. That word volatility means the ride to get there was probably a lot bumpier, with bigger ups and downs. It's the classic risk versus reward trade-off.
All right, let's pull all of this together. Now that we have all of this information on the table, what's the smart, strategic way to think about fractional investing? How do you do it right? And this right here is probably the most important takeaway. No one is suggesting you go all in on this stuff. The expert advice is to think of alternative assets as a small, strategic slice of your total portfolio, somewhere in that 5 to 10% range. They are meant to be a supplement to your traditional investments, not a replacement for them.
And this quote really just nails it. The goal here isn't to hit some jackpot. It's about making a smart, strategic addition to a well-rounded portfolio. You got to do your homework, understand what you're getting into, and only invest an amount that you're comfortable with.
So I'll just leave you with this one question to think about. As you're planning out your own financial future, could owning a little piece of history be the secret ingredient your portfolio's been missing? For a truly diversified strategy, the answer just might be yes. Thanks for tuning in.